Just waiting for a few last-minute people to join us. Thank you. Okay, I think we're nearly complete with all the people joining us, so let's make a start. Good afternoon to you. I'm Martin Sherwood from Enterprise Investment Partners. So this is a webinar on the subject of sea change in the EIS, or in other words, all change in the EIS, massive changes caused by the rule changes in the budget in late November, which will be enshrined in the finance bill, which is currently going through Parliament, and will be completed by a process called royal assent. We're expecting royal assent to occur in March. Now that's quite important that you're aware of the dates, because there are some offers that are still available and which can issue shares under the old rules up to the date of royal assent. So we're expecting royal assent in March, and we're looking to close out an offer that we have that's affected by the changes at the end of February. So let us just crack on. Understand the risks. So as you know, I have to draw the risks to your attention. So a tiny bit of introduction on Enterprise. This is going to be very short, I promise you. We've been going now about 7 years since we broke away from the large city firm. Our philosophy is to follow the money all through the process. So that means raising the money, managing the money, and exiting the money. So managing the money by way of a high quality investor relations service. We believe in transparency. That means providing as much information on the investments as we can to investors before they invest, and of course as much information on the progress of their investment during the investment life. And last but not least, we believe in engaging only with top quality asset managers, and I'll be talking to you about some of those in a second. So that's what we all look like. So we're small but perfectly formed. We've got 2 partners, of which I'm one, and a number of staff here in our office in central London. We're in total about 8 to 10 people, depending on the day of the week. So let's crack on. And now I'm going to be talking to you about the changes. There's a very glamorous lady there looking at you. I'll tell you who she is in a moment. So massive changes in the budget, which was on the 22nd of November. And basically, these changes can be summed up by saying the government is insisting that there must be risk now in any EIS investment going forward. They are determined to disqualify no risk or low risk schemes. So typically capital preservation schemes, certain types of asset-backed schemes where the risk has been effectively taken out or largely taken out. They've introduced a condition now for all clearances going forward called the risk to capital condition. So in the same words, there must be risk in absolutely everything for it to qualify. There is good news in this, so I don't want to be pessimistic. In general, we think the changes are incredibly positive. They are reinforcing and it's the EIS and giving a big confidence boost to the EIS industry. In particular, startup businesses or knowledge intensive companies, that's already been abbreviated to KICs, KICs. Those are the types of businesses that the government is going to favour. Films, actually, and the investment is still available. That's Gillian Anderson, if anybody's a fan of that particular actress. So there's a new principles-based test being applied to all applications for clearance, advance assurance it's called, from HMRC. So there's a kind of interim period at the moment. It is still possible to issue shares under the old rules for companies that already had an advance assurance. But for new companies going forwards, in order to get an advance assurance, they're going to be subject to this principles-based test. So what is the test? Well, it's a series of points. It's a bit like a points system, really, but it's probably more discretionary than that. So it's not done on any numerical basis. It's done more on a judgmental basis. So number one test is the trade of the company, in order to receive qualification going forward, has got to be an ongoing trade. So a trade established with no particular end date, a trade established as an ongoing trade. Also very important, the revenue hates EIS companies that are focused just on one single project. So you'll tend to find that the large projects where there's just one asset only in the company, they are to qualify going forward. So the objective of the business, in order to qualify, must be to grow over the long term. There must be a risk to the investor of losing at least as much as the potential net return. HMRC are going to disfavour or going to not look very favourably on businesses that have got what we call highly predictable income streams. These might be capital projects with very reliable sources of income, possibly renewable energy, that type of likely to qualify going forward. So where there is a certain or a highly predictable income stream, that's likely to fail the test. Also, I mentioned companies with single assets, with particularly companies with single assets where clearly the main objective is to trade the asset for a period of 3 years and then simply dispose of the asset at the end of the 3-year period. That is not going to qualify going forward. HMRC are also not in favour of businesses where most or all of the activities of the managing of the business are subcontracted to other parties. So businesses have got to have entrepreneurs in place, actively engaged in carrying on the business, doing it themselves and not outsourcing it to another party. Any business which is appears to be controlled by the promoter, where the promoter can call shots, wind the business up, etc., etc., that again is likely to be disqualified. And finally, a thing that HMRC now call fragmentation. So that's when you take a large trade that consists of a number of different sites, possibly, and where promoters or arrangers chop those different sites up into separate companies, but basically it's all that is not going to qualify. So it's where it's a major trade chopped up or fragmented into lots of pieces, will not qualify going forward. So those are the main principle-based tests that any application for advance assurance in future is going to have to comply with. So let us look at the ramifications of this and where we think it's going to lead in terms of our own particular products, current and in the future. Before we do that, just a little bit more on what is being encouraged and what is not being encouraged. I think you've got the message, but what is being encouraged is startup businesses, scale-up businesses, growth businesses, businesses with entrepreneurs with a vision to grow, or knowledge-intensive companies. And what is a knowledge-intensive company? It's a company that has usually software of some sort of application, or businesses that emanate from some basic research, very often the university spin-out, for instance. That would be termed a knowledge-intensive company. So that all those are passing the test and are going to be favourably viewed going forward. And the ones that are not being favourably viewed are the single asset businesses. We've touched on that already. Construction as a trade is unlikely to qualify. media companies which rely on pre-sales and production credits, they are unlikely to qualify going forward. Particularly the production credit part, I would say. The pre-sale part is a lot harder to legislate against and to monitor, actually, because it's endemic in normal day-to-day commercial trade on the part of a film or media production company. Certainly, any offer document which says it's going to be relying to a large extent, like 70%, on pre-sales and production credits, will not in future pass the test. Highly predictable income streams, we've seen that already, and outsourcing. Okay, now, where does that leave us with our current production slate? Well, first of all, I'm going to tell you about our media fund, because it's the only one of the funds I'm discussing this afternoon which is impacted by the new rules. We're still able to issue shares for Hindsight. It is, though, a risk mitigation structure. We are looking to invest in pre-sales and production credits. So we will only be able to issue shares for this particular fund up to the end of February. That's to say, before the date of royal assent to the finance bill, which we are predicting is going to be sometime during March. It will definitely be before 5th of April, so we think it'll be probably mid-March, at a guess. So Hindsight, let's just talk about it briefly. It provides investors with a diversified portfolio across film, TV, and games. The Hindsight team have an outstanding track record, having achieved annual average return of 34% over the last 5 years, and quite a lot of those investments were actually EIS qualifying investments, and the EIS qualifying investments averaged a return of 1.2 or £1.20 for a pound gross invested. The Hindsight team are a highly experienced team. They specialize in the top end of the independent film and TV production market. So names that you might have heard of, like Anonymous Content, for instance. And they get involved in some really well-known titles like King's Speech, Chef, Wolf Hall. Some of those titles I'm sure you've heard of. So, as I said before, this is a risk mitigation scheme because 70% of investors' funds is going to be invested initially into pre-sales and production credits. So that those are devices which automatically return cash. So it's highly predictable. It's contractual. So effectively only 30% of the total investment is completely at risk. This is available now. It's a last chance opportunity to get into investment in media with this kind of low risk approach. And we're issuing shares currently for Hindsight, and we'll continue to do so up till the end of February approximately, which is, we think, the day before the likely date of royal assent to the finance bill. So that's Hindsight. Moving on to our next major fund, which some of you may well know because it's been around a long time. This is Imbiba Leisure. Imbiba invest, as you know, in central London bar restaurant businesses, and they've got an absolutely phenomenal track record, arguably the best track record that exists currently in the EIS market. They've had 10 previous exits from EIS companies which have achieved an average return of 35% IRR, which is quite phenomenal record. And their most recent exit was in 2013. That was for the sale of a business called Drake & Morgan, which was city-based bar restaurants, and that returned 5.7, nearly 6 times cash to the original investors in that business. So if you'd been an unfortunate investor and you put money into Drake & Morgan at the outset, your £1 share would have turned into £5.70, entirely free of tax, and that's before taking into consideration the phenomenal return. We've actually got in 2 more businesses that are relatively mature, which we think are likely to exit soon in the Imbiba portfolio. this fund actually is investing in new businesses going forward. Some of them will be top-ups or current businesses, but they will mostly be investments in new businesses. Now, I put down here in the notes major commitment by Inbiba and EIP. That's simply because the partners of Inbiba and the partners of EIP, of which I'm one, we are required to put our own money into each of these investees. And that's not just a token amounts, that's a serious amount of investment. So between us, Inbiba and EIP, we invest no less than £200,000 of our own money into each investee company. So that's a sign of confidence. We've also got, I believe, the highest hurdle rate for management incentive purposes in the EIS industry, which is £1.50. I challenge you to find a higher hurdle rate than that one. So altogether, we think Inbiba is an absolutely superb investment, incredible track record, enormous amount of commitment, hands-on investors. The Inbiba team, they bring particularly property and management expertise to all the businesses they invest in. So happy to talk to you more about Inbiba. It's a very popular fund. Thirdly, I'm going to talk to you briefly about our SEIS fund, which is investing in food and drink products. Now, this is a very interesting fund. It's the first time there's been a specialist SEIS fund in food and drink. We're working closely with our partners, Startup Funding Club, who are specialists in the startup sector and have got incredible track record. In the last 5 years, they've invested in well over 100 companies, I think about 110. So far, no failures. A little bit early to call, but it looks as if the track record is going to be quite amazing. And already there are investments they've made that look like being complete winners in terms of the returns to the investors. So that's based on the share price of subsequent fundraisers. Further capitalizations going forward. So in one case, it looks like it could be as much as 40 times cost. So these are people that we believe are absolutely the best in their industry, and we like their interest in food and drink. Food and drink market, particularly interesting. It's a vast market. It grows very steadily at a 3 to 4% rate in the UK. The major retailers, very interestingly, are very committed to backing startup products. The food retailers, as you probably know, are locked in a fierce competition with each other, and they're looking for an edge or a benefit, and they try to achieve this in part by stocking new products and providing a diverse product range to their custom base. So they will provide free shelves for product trials in their stores, and we're also backed by the outdoor advertisers JC Deco, who will give us free advertising sites if they haven't been able to let those particular advertising sites. So we have first option on any free or vacant advertising site. So I could talk to you for ages about the food and drink market, but again, you might like to read up about that yourselves. Particularly interesting market, and so it's a fund approach. Investors get no less than 10 different startup businesses in the food. Many of them have a health kick because market research shows that consumers are absolutely obsessed with health. Even people who don't have allergies are buying things that are dairy-free, gluten-free, all the rest of it. So there's an enormous obsession with health at the moment, and most of the new products that we're backing on have a health bias to them. Let's move on. Last but not least, we are about to launch, so we haven't launched this yet, but it's about literally to land on your doormats, and that is another fund in collaboration with Startup Funding Club, called the SFC, short for Startup Funding Club, EIS Growth Fund. Now, this is the first time Startup Funding Club have done a growth fund. So this is a scale-up fund, if you like, as opposed to a startup fund. And the intention is to invest in a mixture of businesses, some businesses which the startup funding team have already invested in at the seed stage, but also some businesses that they didn't invest in at the seed stage. So a blend of the two, and it's follow-on funding or secondary funding. This all means the same thing. And so we're looking at growth businesses, and this will be generalist, so it'll be across all sectors, but with a particular emphasis on what we are calling the knowledge intensive sector, which, as we've seen already, is technology, intellectual property, software, etc. So a little bit more there about Startup Funding Club's track record. Well over 100 startups in recent years, including some notable successes. We were actually going to identify these in the documentation for this new fund. There's 3 companies there. One's called OnFido, another is called Cognism, another is called BioEpic. OnFido provides identification. Cognism is a CRM, customer relationship tool, and BioEpic is a really interesting thing, which is it analyzes your health via your phone. It's an application you put on your smartphone. Quite extraordinary. So you might like to find out more about that. Startup Funding Club are award winners. They've seem to be winning awards at the rate of at least 1 a year at the moment. So in 2016 they were winners of the Lead Syndicate of the Year award at the UK Business Angels event. Just last November they were the winners at the Growth Investor Awards of the Best Angel Syndicate Award. So they are regular award winners, and you don't win those awards for nothing, I can tell you. There's very sharp, stiff competition for these awards, and so something right. I think we're nearly at the end, so I'm looking at the time now, see how we're doing. We've got about 8 minutes left, and I'm going to be happy to take some questions in a moment. My colleague is going to bring the questions through to me, and we will start trying to answer them. So let's have some questions. Thank you very much. So Simon, you asked, how can you define predictable income streams? If you ran a ferry business, would the income be too consistent? Well, I'm not going to be the judge, Simon. HMRC are, but I have a feeling that if you ran a ferry business, well, for starters, it wouldn't qualify because it's a shipping business, and shipping pleasure craft do not qualify, actually. So it's a slightly academic question, but I think if you ran a ferry business, if it did qualify, I think the income would not be too consistent because it would be subject to the vagaries of weather and tourist numbers, etc. So I think that probably would qualify. Next question is from James, who's asked, is this the end of pubs qualifying for EIS given their asset-backed nature? Well, that's a very good question. I'm glad you asked it, because I think it needs a clear answer. The short answer is freehold property in itself is not going to be disqualified. However, if it's a single freehold property, a major asset in a company, as we've seen already, I don't think that will qualify. But if it's a business, a company, which is investing in a number of freehold properties, pub-based properties, I think it could qualify. It ticks all the boxes of being an entrepreneur-led business, having no outside control from promoters or sponsors, being a business being built up for the long term, etc. Possibly taking over closed down pubs and relaunching them with a new concept, that would definitely qualify. So it's a principle-based approach, and it doesn't, HMRC are not saying pubs are out or freeholds are out. They're looking at the range of principles that we've seen already. Okay, there's another question from Simon. If the promoter cannot influence, how will a fund provide portfolio management if they have no teeth? I think a fund can still provide portfolio management. As long as the fund manager doesn't have total control over the process, or when the company exits, and so on and so forth. So the shareholders, the entrepreneurs who run the businesses, have got to be in the driving seat here. So I think we can provide a portfolio management service going forward. Another question from James: with subcontracting now frowned upon, are JVs allowed, or informal partnership approach? I think not, James, because joint ventures are actually disqualified already from the EIS rules. So a pure joint venture is not possible under the old or existing EIS rules. So I think subcontracting may be allowed up to a certain level, provided there's an entrepreneur behind the business and that entrepreneur is only subcontracting parts of the business out. So I think it's very much a question of what proportion of the business is being subcontracted, if that makes sense. I've got more questions, so I hope you're all listening. Mario, question from you: what will happen to EIS funding used for buyouts of existing businesses if the businesses have a lot of assets? Well, this is quite tricky, Mario, because the EIS is not usually used as a means of providing a buyout, because don't forget, the EIS shares have to be new shares. They can't be existing shares or second-hand shares. So to buy out a business, you have to form a new co, issue new shares in the new company, and then that company has to acquire an existing business. It all looks to me as if it's going to be quite complicated. You will end up breaching one or more of these rules, quite frankly. So I think the answer is that's not going to work. Another question from John. John says, what is the impact on investments such as Titan Storage? Well, my view, John, is that storage, freehold storage centres will not be allowed going forward. That's largely because of their size. So freehold storage site typically costs 3 million plus, can easily be more, depending how big it is and where it's located. So that means it will be a single asset, and in which case I think it will fall foul of the single asset test. So I think last orders for the freehold storage concept, as you know, self-storage was not allowed anyway. Serviced storage is still allowed, but I think those businesses will have to issue shares before royal assent, and after the date of royal assent I don't think it will be possible to carry on with the storage concept. Now I've got a question here from Philip, who says, let's say a promoter starts a company, he would like to get a majority of shares, 55%. Is that too much? Yeah, I think it's too much, actually. Mainly because it makes it very unattractive for investors if they're buying a minority in the investment and the control of the business is being controlled by the original entrepreneur or the backer or founder of the business. I think shareholders will take the view they don't have sufficient control. So I think really an entrepreneur needs to be a founder. He can have founder shares and he can have incentives, etc., which are attractive, which encourage him to make a success out of the business, but he's got to be a minority holder of the business, I think, going forward. So those were extremely good questions. If anybody's got any more, I need to put my glasses on, I think, to see them. Hang on a second. I've got a question here from Kevin. What is the HMRC position on advanced assurance in terms of timelines for exits? well, HMRC don't like early exits. What they've said in the principles test is they are going to give approvals to businesses that are clearly set up for the long term. So that means longer than 3 years. It probably means longer than 5 years, but it means probably no less than at least 5 years. So I think short-term exits, although they won't in themselves be disqualified, I think that in order to get an advance assurance, if it's very obvious that you're intending to exit the business after 3 years, I think you will not score very high points, and you may well be scuppered by HMRC under their principles-based approach. Another question: share issuing before finance bill assent or EIS certificate date. So the shares have to be issued before the date of royal assent to the finance bill. So if the finance bill is on the 15th of March, say, the latest date the shares can be issued is the 14th of March. So it's got nothing to do with the timing of the tax certificate or the share certificate. It's all to do with the date the shares are issued. So they cannot be issued, in that example, later than the 14th of March. Philip is asking about follow-on. If the promoter holds 55%, would HMRC object? Let's leave the investors to the side. No, I don't think HMRC would object. I don't think they would have grounds for objecting. So I think the comments I made before were probably comments around the commerciality of a founder controlling the shares in the business. But I think from the rule point of view, it probably would be permitted. And you've said thank you. Now, I think we've reached the end of our time. I'm happy to go on taking questions if you want to carry on asking them, but otherwise I will be closing in the next few minutes. I just want to say thank you very much for your time and attention this afternoon. If you've got any queries on anything I've said, of course, be in touch with me. Happy to assist you with the new rules. Also, of course, happy to assist you with any inquiries about our actual offers ourselves. So many thanks. I'll wait online for just another couple of minutes in case there are any further questions. Thank you so much. Thank you. Any more questions? Thank you very much.